Is there a difference in the order that you should invest, whether you're a high income earner or you're just a quote unquote regular income earner? And as a fee-only financial advisor for over 20 years, I can share with you definitively that yes, there are differences. So in today's video, I'm going to go through what those top 10 differences are and how they might impact you. So let's jump in. The very first one is your emergency fund. We all need to have an emergency fund, but I would argue if you're a high income earner, you need to have a larger emergency fund. And here's why. It's harder to replace that job if something were to happen. If you were to lose your, God forbid, lose your job, it takes a lot longer to replace a $400,000 a year job than it does a job that's maybe $50,000 a year, that there many more of those jobs are available. So for high income earners, I think you should have at least 12 months in your emergency fund, maybe even as high as 18 months. What you want to put yourself in a situation where you get to decide which job is the right match for you, and you're not feeling a lot of pressure to take the very next job. Now, for those of us that are normal income earners, and I should define what I mean by that, and I will in a second, but for quote-unquote normal income earners, I think 3 to 6 months is sufficient. More is always better, but think through for yourself if you were to lose your job. How many months would it take for you to find another job that you're excited about? And if that's 3 or 6 months, then, that emergency fund level is about right. Now, for both high-income earners and quote-unquote regular earners, we still have the unexpected expenses that can come up. Your car breaks down, the roof on your house needs to be repaired. But those tend to be in the ballpark pretty similar between different income earners. So when I say high-income earner, I mean $250,000 or more. When I say regular income earner, I mean $50,000, which is the average U.S. salary for an individual, $50,000 U.S. dollars a year, all the way up to $150,000. And I know that leaves a donut hole, but it makes it much more complex if I don't leave that gap in there. So just bear with me. Okay, so that's the first one. What's the second one? The second one is your 401k match at your company. If your company offers a 401k match, I think you should do that if you can afford to do it. Job number one's that emergency fund, but that quote-unquote free money by your employer is really valuable. Essentially, up until the match, every dollar you put in and your employer is matching for a dollar, that's 100% return. And you know what? It's really hard to get 100% returns in today's world, so I encourage you to take advantage of that. Okay, what's the next one? If you have deferred compensation options at work, and that tends to be for executives at companies, they're making enough money that the company knows they're paying really high rates of tax, and they can offer a deferred compensation plan to those employees. So regardless of what your salary is, if you're offered that and you are in a high tax bracket, let's say you're in the 37% federal tax bracket, if you're in a state that has state income tax, if you're subject to other add-on taxes as well, that can be a really attractive alternative, a really attractive option that your company is offering. So definitely look into that. I should say none of this in today's video is financial advice for you. It's really to put things on your radar screen and for you to think about. So I encourage you to work with a fee-only financial advisor or an accountant. Okay, now some companies also offered a discount on company stock. For instance, when I was an entry-level employee right out of college, my undergrad was in engineering and I was working for a Fortune 500 company. They allowed us to buy the company stock at a 20% discount. And interestingly, it was based on the average price for the month. So when the stock price had gone up and I could get that 20% discount, and I could do back then when I was making my starting salary 40 years ago was $36,000 a year. I could do $200 a month in company stock. And if the company stock had done well, I could buy it at the average price for the month, and I could get a 20% discount off of that average price, and I could sell it the very next day. Technically, I could sell it the same day, but everybody told me I should wait at least a day. So that was free money for me. You know, I could pick up $25, $50 a month, which back then would buy a nice dinner. You could go out on a date for that kind of money. So if you're offered that and you have the opportunity to turn around and sell that stock right away, I think you should do it. Now, importantly, if you have to hold on to it for a period of time, it becomes a much more difficult situation. I don't want you to have too much exposure to your company. Your livelihood, your salary already depends on that company. So I don't want you to have too much exposure to that company. And the classic case of that was Enron employees, which was a company that in 99, 2000, 2001, right in that range, just really blew up. The company fell apart. There was all kinds of fraud taking place. And people had maxed out their 401k in company stock. People had bought an additional company stock. And that had served them very well for several years, right up until the company went out of business. And I don't want that to happen to you. So if you can't sell it right away, remember, you've already got enough exposure to that company. So this isn't stock advice, but risk management is very important. Your fifth is credit cards, paying down expensive debt. For most of us, that's credit cards. Some of us might have expensive car loans. And if that's you, I'd encourage you to pay down that debt as soon as you can. So pay down that credit card debt, pay down that car loan if you can. Let's say you're paying 10%, 12% on the car loan. Let's say you're paying 20% plus. You know, that's a return that you can pay yourself by paying off that high cost debt. The next one is your 401k at work. So through your 401k at work, many of you know you can put in, if you're under 50, you can put in $23,000 a year. In 2024, that's just gone up. It used to be $22,500. And then if you're over 50, you can do what's called the catch-up provision. You can put in an extra $7,500. So that's a lot of money. If you're over 50, between your regular contribution and your catch-up contribution, that is $30,500. So that's a lot. And actually, if you're a high earner, sometimes you can negotiate with your company to get a more generous company match. And between your contributions and the company contribution, there can actually be put $69,000 in total in your 401k, whether that's a Roth or a regular. Now, if the company match goes into the Roth IRA, just be aware that's going to count as taxable income to you, but you're not going to get the cash. So just be aware that situation. Okay, let's keep going here. The next one is, to the extent you have the option of a high deductible health care plan, you can do what's called the health savings account. Now, for some people, that's not going to make a lot of sense. If you happen to be in a family that needs a lot of healthcare expenses, if you experience a lot of healthcare expenses, I should say, it may not make sense for you to do that. But to the extent you're not a big consumer of healthcare expenses, for a lot of you, it'll make sense to actually do a health savings account, an HSA, whether you're a high earner or quote unquote a regular earner. Health savings accounts can be a beautiful thing, and they're beautiful things because you put your money in, assuming that you're in a high deductible healthcare plan, you put your money in pre-tax dollars. It grows tax-free, and assuming you're using the money to pay for qualified medical expenses, you take the money out tax-free. So it's the trifecta. If financial advisors were in charge of creating a retirement account, that's what we would work for, is you get the tax break on the way in, it grows tax-free, and you can take it out tax-free. Now, the secret is you don't have to use that money in the calendar year for the healthcare expense in the year that it happened. Just save that receipt, and that receipt is good for life. Now, make sure it's not just your credit card receipt, but where it line items what you paid for that. But if you save that receipt, you can take that money out in 20, 30, 40 years, something like that. So just save the receipt, and it can turn into a very powerful health savings account. Many of my clients have health savings accounts with over $100,000 in it for that reason. So it can be a super powerful tool. For a single person, you can put in $4,150. And for a family, you can put in $8,300 a year. So that's a really nice tax benefit. Now, one thing that very few that I've never heard on YouTube actually is be careful with how much money you have in your health savings account, because if you pass away with a health savings account, other than your spouse, whoever inherits that money has to take that money out in one lump sum. And so that's going to be assuming you have $100,000 or maybe it grows to $200,000 or even $300,000. That can be a lot of ordinary income in 1 year. So it could be tax inefficient to leave it for an heir. But remember, even at 65 years old, even with Medicare, Fidelity says that the average person is going to have about $150,000 of medical expenses after the age of 65. And that does not include long-term care, which 60-70% of us, unfortunately, are going to need long-term care. Okay, let's keep going. The next one is a backdoor Roth. So if you're married filing jointly and you're making over $230,000 a year, you cannot put money into a tax-deductible IRA. And that's why I made these split. High income earner being $250,000 and above, I could have said $230,000. And then regular income earners, regular wage earners, $50,000 to $150,000. So if you're in the regular wage category, you likely can put money into a regular IRA. So that might be something that you want to do. But if you're a high income earner, you can't put it into a regular IRA, but you know what you can do? You can do a non-deductible contribution to a regular IRA, and then you can turn around, you can roll that into a Roth. That is called a backdoor Roth. Let's go for a walk and talk about these last ones. The next one's really a really powerful tool, which is 529 accounts. So in 2024, you can put up to $18,000 a year in your child's 529. Actually, you can do that without using any of your lifetime gift exclusion. You can actually put in more than that if you want, but you're going to have to file a gift tax return with your tax form. So you can do up to $18,000 a year, but here's something very few people talk about. You can do 5 years worth of gifting into a 529 account. But you can only do $18,000 a year per child. So if you've already given your child maybe $2,000 to help buy their next car, well, your 2024 limit, which was $18,000, that's a limit. That's not, per gift. That's that's a calendar year limit. So $2,000, you would take that $2,000 off of that $18,000 limit, and now you could give them $16,000. But let's assume you haven't given your child any gifts so far for the year. You can do $18,000 a year, and you can also do this 5-year grouping. So you can do 5 years worth of gifting in 1 year. Now you can't give any more gifts to that child for the next 5 years, but you can do that for the 529, 5 years worth in 1 calendar year. It's just something that the IRS allows you to do. Congress, the government allows us to do to kind of supercharge that 529. Now that's, if you're married, you can do that 5 years worth of gifting if you want, which is $90,000. Your spouse can do it. So it's $180,000 in 1 year that you can put in one child. Now 529. Now it used to be a 529 account. You did not want to overfund. What do you do if your child doesn't go to college and you've got $200,000, $300,000 in their 529 account? That's still a concern. But assuming you can get most of it out, starting in 2024, two things happen. In 2024, for money that's been in a 529 account over 15 years, and assuming for an account that's been open 15 years, for money that you contributed in for more than 5 years. So again, this is a lot of numbers, but look it up. This is to put it on your radar screen. But if it's money over 5 years and the account's been open 15 years or more, they can do up to $35,000 from that 529 into a Roth IRA. And they can do that income tax-free. So that's a really powerful thing. But again, this is just to put it on your radar screen. So that'll take care of some of the money. But here's the other thing is you can take money that you set aside for your child for college expenses. And if your child doesn't use it all, you can continue to let that grow and then change the beneficiary to your grandchild. So there are rules, related family members, and I encourage you to look up what those rules are. But a 529, you can put a lot of money in an account like that. Okay, let's keep going here. So that was number 9 and number 10. And I've got a bonus here too. So don't tee off here yet. Pay off your low interest debt. If you have like a mortgage. Even if it's low interest, even if the academic answer is, you don't need to pay it off, for a lot of us, the sleep at night factor is such that, we probably do want to pay off low interest debt. It depends on who you are. If you've got a 2.5%, 3% mortgage, boy, it's really hard to pay off inexpensive money like that. But if you've got a 6%, 7%, 8% mortgage, it's a lot easier to do that. But there's the academic answer, and then there's the sleep at night factor. And the freedom that not having a mortgage gives you. If you can be mortgage-free by the time you're in your early 50s, if you decide you want to retire early, that gives you a lot of flexibility. It's a lot easier to retire early if you don't have to worry about paying down your mortgage still. And then the last one is, just put money in a regular taxable account. It's really important that not all of your money are in these tax advantage accounts. We've talked about a lot of these. We've talked about the 401k. We've talked about, doing a backdoor Roth conversion. We've talked about 529 accounts, but it's also nice to have money that is not in these tax deferred accounts. I really think you want to have money in 3 different buckets. And those buckets are something like a Roth IRA, which is, I'm going to pay my tax today, but then never charge me tax on this account. So tax me never account. Then there's a regular IRA, a regular 401k, which is don't tax me now, but tax me later account. And then there's the bank account, a regular taxable account, which I call a tax me as I go account. So by having money in these 3 different accounts, you can control what your taxable income is. So in retirement, you don't want, if all your money is, let's say, in a regular IRA, then all of your distributions coming out of it are taxable income. And I do have friends that say, every time I go to the grocery store, when I buy a gallon of milk, I have to pay ordinary income tax on that because they had to take that money out of a regular IRA. Don't let that happen to you. Plan ahead for that. Also, I want to encourage you to, as a high income earner, as a regular income earner, boy, we've worked hard for our money. And I want you to think about taking advantage of that. When you've won, I want you to reach out, grab that brass ring, and live the life that's best for you. Maybe that's early retirement, maybe it's not. But this video here talks about 5 reasons to retire as soon as you can. I'll see you in there. Bye-bye.